Okay, so dear friends of Blackfort, dear partners, dear colleagues, we are again ready to present you our Market Watch, which we do every 2 weeks. We share our view on the markets, on different instruments, and on the situation which globally influences investments of our clients and of our listeners. And we would be glad to share this view again with you. We have here Oleg Falikovic, who is co-owner of Blackfort Capital and a managing partner. And we have here also Andreas Bickel, our CIO, and also Arseny, who is head of Russian business development. We have also other partners and representatives of our company here, but I won't name everybody. For now, I just want to stress before I hand over to Andreas, who's going to start his market view, that we post this video every 2 weeks on YouTube. It comes in English and it comes in Russian. So we have also a translated version. And please subscribe to our YouTube as well. We do post regularly macro comments on LinkedIn page of Blackfort Capital. And of course, all the materials also available on our website, blackfort.ch. You're very welcome to visit the website. And yes, so I would like to hand over to Andreas Bickel. We will ask him some questions in the end of the presentation. And but for now, yes, I'm pleased to hand over to you, Andreas. Thank you very much.
Thank you, Glad, for the introduction. So welcome everybody to our bi-weekly market call. Okay, today's agenda is a follow-up on what we have said the 2 last times. So one topic was sell in May and go away. I will present an update. We have seen rallies in the equity market, but a bit forgotten also in corporate bonds. Then the future obviously depends on how the economy will recover. Is it V-shaped like in China, or is it different? We have some frequent data, high frequency data, which give us some hints. Then we do know that markets are expensive. I will give an update on that. Maybe 1 month ago, the theme was the dollar is going to weaken. Unfortunately, since then, we have seen a trend range bound in dollar. But in the meantime, in the last 2 trading days, this has changed. So I will give an update on that and reasons why. And last but not least, the conclusion as always. Last time there was a large session about sell in May, go away, or make or break in the S&P. My favorite chart and also hypothesis was this one, my base case scenario. So basically we were hoping that there will be a breakout of this trading range. As we speak, the S&P is roughly at 3,050. So therefore that has happened. But as always, what's next, especially given the seasonality? Here you see the same shown with the SPDR. The SPDR is the largest ETF and the oldest ETF existing in the world. It has obviously risen 1-to-1 compared to the S&P. The guy who did that chart raises a question which is often raised and differently answered. We have seen a sell-off with a spike in volume, and since then we see a climbing the wall of worry or creeping up with declining volumes. There are 2 theories behind that. One is if something goes up with low volume, that's a very bad sign. A lot of technicians would tell you that. And there is another one, a minority one. I belong to that group. Actually, if you have seen a sell-off, a spike in volume, and then a creeping up or a climbing up of the wall of worry, I consider that as a bullish sign. Very controversial. So far it has worked out. One of the reasons why this happened, this chart we have shown in the past, we've seen tremendous inflow into money markets, and we see outflows in other major asset classes, mainly equities and bond. So one point is, where shall the additional seller come from? The rally so far was driven by the FANGs or FANG Plus. Here you see the FANGs on the top. The FANGs here today would be up 15%. This chart is from yesterday, so there's really actual data. And the S&P without the FANGs would be down minus 5%, so a huge gap. And you see also the impact of these 5 stocks to the whole index. The whole index would be down roughly 8%. But what this commentator have forgotten to mention is the spike over the last 2-3 days. I mean, so far the rally was driven by the FANGs. You see the dark blue line is flattening or even slightly falling, while the broader market is climbing up. Much better you can see it here. The white line is the Russell 2000, so small and mid caps in the US, compared to the major index, so Nasdaq, S&P, and Dow Jones. And as we can see over 1 month roughly, actually most of it since May 15, we have seen a tremendous outperformance of the cyclical stocks and the small mid-cap stocks, and to a lesser degree also of the value stocks. And that is actually a bullish sign, because in the end, the market is not just driven by the 5 stocks, or maybe the FANG plus roughly 10 stocks, but the rally is getting broader. It's a bit scary as we haven't seen any setbacks, any pullbacks. You see this also here in a different way. Here is the MSCI World, all countries, so including emerging markets. The blue line shows the outflow of equity products, and the red one shows the price development of the MSCI World. The guy who did that, that's Citigroup. They are extremely cautious, not to say bearish. They have to conclude, or they concluded, is a quote, so equity can rally much longer, even without inflows, then you can stay sane or solvent. It's a bit stolen from Keynes, because he said very similar things. He basically said markets can stay much longer irrational than you can stay solvent. But the point is, this rally is going on, and there is outflow. However, the outflow is not so big. So over the last 2 months, we have seen roughly 0.8% of AUM, also less than 1%, or 120 billion outflow of equity products, while in the past, during 2008-9, we have seen 8% of AUM flowing out. Nevertheless, we see euphoria. This is again Citigroup. Citigroup, as I said before, is very cautious. They claim, based on their euphoria panic model, that we are at euphoria and forward-looking, the returns will be low. That is not completely wrong, because there is a strong correlation between forward-looking performance and this stand of the index. However, if you look at the period around 2000, you see that the euphoria area can last for a long, long time, and markets can raise and get more and more irrational. On the other hand, there is support. The support here shown by the G4 central bank balance sheets. This is the actual standing, not what will be implemented. And you see the huge spike since roughly 4 to 8 weeks. And with the spike, the equity market. As we speak, there was over the weekend announcement that there will be more fiscal stimulus in Japan. There will be probably more monetary stimulus in the Eurozone. Last week announced was a new package fiscal stimulus in the Eurozone. It's not yet approved, but it was 750 billion. If you add that up for Europe, that's an astonishing 1.25 billion additional stimulus. In the US, still in the parliament, is the discussion about the next more than 2 trillion fiscal package. Basically, they are agreeing or disagreeing on details, but both parties agree that it must be at least 2 trillion. One wants a bit more, the other one wants a bit less, but it is fair to assume that this stimulus will come. All this supports equities, but it also supports corporate bonds. This is a kind of normal that when you see equities rallying, that you see at least high-yielding bonds, so bonds with lower quality in the balance sheet, going hand in hand with equity. You see that the spreads 2 weeks ago, for instance, for the US, we were at 206%. This is normalized, and now we are at 177. And the point is, we had a spike almost to 300. And now we are creeping down, and you see that in the performance of various bonds. The Fed is definitely guilty for that, or positively taken. The Fed has ensured that fallen angels like Ford or Boeing have A, access to the market, and B, the new issued bonds. Most of them trade at 105 to 115. This window of opportunity is really used by a lot of people. It is a bit scary, but it is not completely unexpected, especially given the size of the stimulus we have seen and what we have heard will be implemented in a short period of time. Nevertheless, this was driven more by stimulus. We cannot close the eyes completely that both US bonds here, government bonds, and US equity shown by Schiller PE, they are at the 95th percentile compared to its own history. So they are both very expensive. Or to revisit the idea of Schiller, Schiller is the horizontal x-axis. So everything above 2025 is expensive. You see that Denmark, USA, Switzerland, New Zealand, and to a lesser degree the Netherlands, they are in that range. But that basically means that over the next 10 years, the performance of these markets will be roughly between 3 and 5%, so extremely low. This correlates with the price to book ratio, that's on the y-axis, and you see that equity markets with low PE, Schiller PE, have most of the time also a lower price to book. These are mainly European markets and Asian markets, and with rare exception, you see some other areas, but the bulk of it is there. China is also there. China A share have performed tremendously, while Hong Kong, given the recent riots, didn't perform so well over the last 2 weeks. But from a valuation standpoint, it is definitely fair to say that the markets are not cheap, in particular the US and Switzerland. To a lesser degree, you can argue about other areas, but forward-looking, if the US is not going to stay at least stable, it is extremely difficult to assume that all the other markets will go up sharply if the US is going down. Having said that, I repeat what I've said 2 weeks ago and 4 weeks ago. Markets are expensive on both sides, on the equity and on the bond side. However, in corporate bonds, the spreads are still offering attractive levels, not so attractive like 8 weeks ago. And on the US equity side and the global equity side, it is hard to find alternatives. It all boils down to how we will see the recovery, if there will be a recovery and how strong it will be. I'm in the camp of V to U shape. However, this starts all with the development of the lockdown and obviously the cases of Corona. You see here that the US and Brazil have had yesterday 22,000 and 14,000 new cases. Russia has had roughly 9,000 cases yesterday. All 3 countries are opening up, although the cases are rising. On the other side, you see at the bottom, you see China and South Korea. The number of new cases is extremely limited. They both have implemented severe tracking of people. So if somebody is ill in a restaurant, in a cinema, wherever he or she is caught, everybody who was in that room is tracked via software, and they will be all put into quarantine. An interesting example is Portugal. They are considered in Europe to be one of the countries who has managed the best the system. They didn't really implement lockdown effects. They didn't force people to stay at home. But as you can see, the number of new cases or the deaf people or the absolute amount in percentage of the people who live there is extremely contained. What is extremely interesting, but nobody really can explain why the neighbor country Spain, fourth on the top, or Italy, so similar countries, similar cultures, they have much more cases, they had much more deaths, and they managed the crisis in a less good way. What this all means is that the case numbers come down, they are still high, and with it you see effects. And obviously China is at least 4, maybe 8 weeks ahead of us. Here, another data to indicate that most likely the economy, at least in terms of usage of electrical power, is back to pre-crisis level. So you see here the coal use for producing electricity. What you don't see is that the latest PMI data, they were a touch weaker, but nevertheless, they were above 50, so they were in the growth area. I would argue that at the moment, such PMI data, sentiment indicators, do not tell you much about the future. But also from that angle, we are at levels seen before the crisis. The question obviously is, China is one thing, what is in the rest of the world? Here you see mobility data provided by Apple, an update, and you see that we are going up. At the end of the spectrum is Italy and Spain. They are extremely cautious with opening up. Somewhere in the middle is the United States. And at the top is Sweden, which they didn't really have a complete lockdown. What this data tells us is there is definitely a pickup, but it doesn't look like a V, it looks rather like a U, and some might even say a hockey stick recovery. Economists keep telling us every week new forecasts. I have picked up this one and highlighted the minus 39% for Q2. This is not really new because before we were already at 34 minus. The key message here is completely a different one. Goldman claims in Q3, Q4, we will see 29 and 11% nowadays. Before they were at 19. So what looks extremely positive actually is not positive at all. If you have something goes from 100 to 50, so minus 50%, obviously you're at 50. It recovers 50%. Well, unfortunately, you end up with 75 and not 100. So this plus 29% in Q3, although much higher than the 19%, means that actually the recovery would be rather U-shaped than V-shaped. Yesterday, Morgan Stanley produced their forecasts. They are extremely positive on equities, and now their economic forecast is adapted. So it is V-shaped with a bit of stretched second part of recovery. Key message here is they believe that we will see until the end of next year levels of GDP of G10, so not just the US, G10 of the same level, and it will be much faster than in 2008. And obviously, if that is true, the rally we have seen in equities and in corporate bonds would be well supported. The jury obviously is still out. The future will tell us and show us in one way or the other if the bulls or the bears are right. It is at least remarkable that in this case, economists also confirm a positive outlook, but this is the rare exception. I have said 8 weeks ago, 6 weeks ago, that most strategists expect, due to the expansion in the US, the dollar to weaken on a global scale. This you normally measure with the DXY index. and you see that during the crisis we had a range bound roughly between 99 and 101. However, over the last 4 trading sessions, this correlation has broken down. We are down or out of the trading range. We are below the 200-day moving average. And most people who comment on that expect the dollar to weaken further. This will have or would have effects on the outlook of the economy of emerging markets, and obviously with it of investments there. We focus, as you know, on bonds, hard currency bonds of that area. But it also has an impact on the inflation outlook, and it has definitely an impact on gold. This chart we have shown 2 weeks ago. The key assumption is that most likely next year we see a higher inflation rate than today. That's quite simple, because at the moment we have disinflation and we are getting closer to 0 than to 1% in most areas. But these strategies claim that we will see inflation creeping up higher and stay on a higher level due to the massive stimulus. In at least the research papers I read, I come across now regularly the term financial regression, which I have used several times over the last 2 years. And one of the key effects of the financial regression is to inflate away the debt burden, so that in real terms, debt to GDP will shrink. And this is just another aspect of the same story, although these two strategists haven't used the expression, but it is definitely used in various research. This has obviously an impact on gold, but it's not the only one. The stimulus is by far a strong support of rising gold prices, but there are other things which are discussed. The Fed hasn't decided on negative rates. However, yesterday again, discussion about yield curve control, similar to Japan. The 2-year yield is on a historic low in the US. And sooner or later, the Fed has to see if they really want to manage the yield curve by buying and selling in certain time buckets of the curve. This is expected, but what is not expected, that we will see negative rates from the Fed itself. There is actually also no need, because the shadow short rate is negative in America, is also negative in Switzerland. As an example, this is a kind of indication where the yield should be if there wouldn't be any kind of intervention. And also this one shows you that in real terms, you lose money. And if you lose money, cash is not an alternative. But gold, or the holding of gold, the opportunity costs have shrunk, or actually maybe the storage cost compared to the negative yield or to the cost you pay for holding euros and Swiss franc is even more than compensated. Most gold bulls expect this to go up above 1,800. We are already on a multi-year high. There is not much left to the all-time high. I would definitely recommend to invest a part of the portfolio into gold. I would not consider that to make a lot of money, but at least to have a certain protection if you have too much cash and you don't know where to deploy it. With that, I'm already at the end of the update. Not much really has changed in the last 2 weeks. The key difference is we are probably 8% higher in the equity sides, and we are also substantially seeing higher bond prices. Therefore, the buying of such instrument, it gets more risky. The alternative, unfortunately, is not here. Therefore, we still consider the 3 pillars in a portfolio to be, on one hand, equities. I would probably wait for a weakness, in particular, given the strong move, given that we haven't seen any counter move. Most likely the new support level, which was the resistance at roughly 3,000, will be tested in the coming months. So it's maybe there's no rush, no need to rush in. bonds are very well supported by central banks and by the stimulus, and also the risk of default has risen on one hand, but on the other hand, given at least in the USA, where you have easy access to credit facility via the Fed and BlackRock, there are a lot of so-called zombie companies. This is a term we use a lot in the German language, which is not used in the Anglo-Saxon research papers I read. But basically what it means, you keep companies alive with credits for almost zero interest rate, which otherwise wouldn't survive. We have seen also some economic leaders who stressed it's now the best time to raise bonds, issue as much bonds as you can at these levels because the best might be over. We can also say the opportunity costs have risen dramatically, so the function of a yield or of a return is unfortunately at the moment not really here. So if you see a price tag / a yield, it doesn't really tell you much of the quality of the things you buy. Words of warning, they are the same like before. I don't think that assets are cheap by any measures. However, different to last time, we see unexpectedly, I must say, or at least for me, that Japan and the Eurozone both have agreed to stimulate further, although they still don't know how much the actual stimulus will impact and if it will work at all, but there will be more. The government bond yields are low, but they might depress further thanks to the massive buying programs out of the four major central banks. There is a risk of melt-up and also of inflation due to the stimulus. Fear of missing out, or TINA, there is no alternative, are things you read regularly in newspapers, not just in research papers. The pain trade, all these economists who have updated their forecasts about GDPs, they are extremely negative. Some of them give advice on investments. The advice didn't work out so far, so the pain trade is definitely on. And if we see inflation down the road, at least in the US, at the moment we see global disinflation, this might, for the US at least, over time solve the problem of the debt burden. I have read again that not just Mr. Powell, but also Mr. Buffett both said, do not fight against the US economy. It's a very simple advice. It is almost too simple, but so far it has worked. In the past 100 years, every time the Fed and or the fiscal measurements were taken, and they have tremendously supported the financial markets. This time, so far at least, it is not really different. Therefore, stay invested. Try to concentrate on quality as much as you can. In the high yield area, we are buyers of double Bs or fallen angels, but all the other risk aspects you shouldn't forget. But down the road, we still would argue that over the next 9 months, roughly, so till the year end, markets probably will continue to stay on a high level, or might even be higher by the end of the year. Thanks a lot for listening.
Georgie, could you switch on my video? Yes, please. Yes, Andreas, I first of all thank you for the insights which you showed on the global economy. I liked very much the Goldman Sachs projection of the economy, and it was very interesting to see that the numbers are actually either showing us a U-shaped recovery and a V-shape, despite the numbers which are like the recovery next quarter should be actually higher than previously expected. What I just wanted to add, Additional to these projections of the economy of Goldman Sachs and Morgan Stanley you showed for China also numbers such as coal consumption, electricity consumption, and so on. Do you have similar data for Europe and US? Because usually we talk always about GDP or GDP assumptions when we talk about developed economies, and use rather hands-on data when we talk about China. But it will be very interesting to see whether we can get real data on Europe and US, except this mobility index which we showed, which also would represent the recovery in this part of the world. Maybe you could prepare that for next time if you don't have access right now. That would be great.
I mean, the short I had also from Milan and Madrid the usage of the public transport. This is a statistic which from time to time shows up in research. Unfortunately, I don't have the original source page where it comes from. What they show is that in these two cities, and this shouldn't come with a surprise, so Milan and Madrid, they are at roughly 20% of normal usage. And if you remember the mobility data from Apple, they are showing exactly the same picture. These two countries are at the bottom. Unfortunately, others like coal usage, etc., so far I haven't come across.
Okay, maybe next CIO call, which will be in 2 weeks, will be interesting to get some more information about Europe, about Switzerland, since we are sitting there, how the recovery goes on. That was more like an addition to the presentation. The question I have is, you mentioned, you showed us a graph where we see outflows of 120 billion from the funds outflow, which are representing basically the fears of investors. But even these outflows could not stop the rally of the equity stock. And for me, this is kind of understandable because we know that the US proposed a 2 trillion stimulus package, which is 10 times, 20 times as big as the outflow actually was from on the fund side. So this is completely a different dimension. My question is, do you have an understanding how actually this 2 trillion gonna influence the economy? And when you talk about the US, we usually talk about S&P 500, which is representing just a part of the economy. Since this big package will land or should land, at least as I understood, maybe you can correct me, in the economy, in the companies, also in the small and mid-sized companies, isn't it more logic to buy companies which are not overbought yet, because S&P, everybody's buying S&P. So for example, isn't it more logical to look at a Russell 2000 or some different kind of investment opportunities? What do you think about that? Thank you.
Well, first of all, the old more than 2 trillion package had a component where there will be credits given to smaller and mid-sized enterprises exactly to support them. The additional discussion in the US, as far as I have seen and understood, is about how to help exactly the economies, the smaller companies, the cyclicals. Therefore, the Parliament is trying to access this question and this issue. And buying the Russell 2000s over the last 2 weeks, definitely you would have made an outperformance. And it all boils down to recovery, yes or no, and how much. But if you believe in a recovery, most of these Russell 2000 stocks are extremely cheap. They have had a tremendous sell-off, and they might catch up. The key question or the open point is, will this only be in small and mid caps or also in the value? It is probably the 20th time over the last 14 years that people discuss, now it's the time to buy value, because value is cheap. That is definitely true. And value will now start to outperform growth. And this is completely open. So I would be careful to make that bet. But if you believe in the outlook of Morgan Stanley, and I'm more in that camp, so I'm rather in the VU-shaped camp and definitely not in the camp of the hockey stick or something like that, then it could make sense to add additionally, and I would like to stress that, to add additionally some small mid-caps, at least in the US. If I look in Europe or if I look in Asia, at least so far, I haven't seen any strong recovery there yet. Might come, it all depends on, obviously, on the pickup and on the speed of how fast we get out of the lockdown, and if there will be a second wave, and especially when and how strong. Some virologists told us that the second wave, the real second wave, might only come in autumn or in winter. And what we see over the summer will be, if any, a very contained, mild rise in case numbers. Any other questions?
Okay, if we have no more questions to Andreas Bickel, who is repeating CIO Blackfort Capital, I would say thank you to all participants for joining us. We will be live again in 2 weeks. And I also remind you that we have this bi-weekly Market Watch also available in Russian language on our YouTube channel. So thank you very much, Andreas. Looking forward to see you in 2 weeks and discuss the market situations again. Thank you very much.
Thank you.